pay attention to it. So the same folks who will spend, weeks and weeks, evaluating the differences between one flat screen TV versus another. They understand the specs of it before they purchase. They will buy a mutual fund based upon hearsay. They'll buy a stock because they see Jim Cramer recommended on CNBC. The key thing is to have a strategic plan. And what happens is people don't have a plan. They think they have a plan, but they don't. So, for example, 401k plan. Most of your listeners probably have a 401k or 403b plan. Most folks will sign up for it. They'll choose half a dozen funds, and they will never look at it again. They'll get their statement, but they don't really pay attention to it. That's problematic because the most important way to build a nest egg, whether you're in your 20s, middle age, or whether you're trying to generate income for the rest of your life, is to focus on diversification. That is the holy grail of investing, of financial success. And most folks don't understand diversification. They think that it means having a lot of different stuff. But it doesn't. What happens is people will have 6 different mutual funds and they think that they are diversified, but they're all U.S. large cap stocks. They're all the exact same type of investment. So because you have an Oppenheimer fund and an MFS fund and a Putnam fund and a Fidelity fund, it doesn't mean you're diversified. What you really need to do, and what we lay out in the book, is have what's called true diversification. And what that means is you want to have assets that move in opposite directions. So it zigs when the other one zags. So a perfect example that people would understand is JetBlue and Exxon. So they are totally non-correlated. So when gas prices go up, Exxon goes up, but JetBlue goes down. And vice versa. When oil prices go down, JetBlue goes up and Exxon goes down. Those are called totally non-correlated assets versus Exxon and Chevron, which tend to move pretty much up and down at the same rate as would be Southwest and JetBlue. So you want to have a variety of asset classes so one of them is always outperforming. And the reason people get hurt and the reason why bubbles exist in the market, like we did with technology, like we did with finance, like we did with commodities in '08, was people do not rebalance. And they don't think about rebalancing. And in fact, they actually do the opposite. So what happens is when high tech becomes hot, like it did in 2000, and actually through the whole 90s, people kept pouring money into it. So they were way overweighted in this very risky asset class of high technology. And some people had 80% of their stock investment in high tech. Mm. So when the floor went out under them, they just went straight down. Right? They went straight down fast. And so what you need to do is constantly rebalance. So what you want to have is a plan. And your plan should be, well, let me go back again. Because the other thing is people focus way too much on performance, right? They want to beat the S&P 500. The way you beat the S&P 500 is to invest in an asset class that beats the S&P 500. So over the last 10 years, the S&P is virtually flat. You would have done just as well putting your money under the mattress. So the decade of 2000 to 2009. But over that same time period, almost any other asset class did well. Bonds returned about 6% annually. Commodities did very well. Emerging market stocks did very well. Real estate did very well. So those kind of asset classes that you need to have exposure to. And people say, no, I don't want emerging markets because they're too risky. Well, it's somewhat counterintuitive, but you actually reduce the risk of your portfolio by adding some riskier asset classes. I've always been struck by the fact that a vaccine actually includes a small dose of whatever you're being vaccinated against. It's sort
yes.
It's sort of the same thing with investing. You actually want to have some riskier asset classes like commodities, like a 5% allocation to commodities, because that actually will even out the entire portfolio and lessen the volatility and risk level of the portfolio. People never brag about how much risk they're taking or how they're managing risk, but that's the most important part of successful investing. Again, whether you're starting out in your 20s or you're withdrawing money in your 70s, you want to manage risk. The best way to build a nest egg is to not lose it, right? And the best way not to lose it is to be diversified. Now, to be totally truthful, in 2008, end of 2008, there was nowhere to hide. Everything went down. But some things came back faster than the stock market. So, for example, junk bonds, high yield bonds, did very well in the first quarter of 2009, while the stock market